Hi everyone, you're all very welcome to another market update here at the Alpha Capital Group. Of course, today we have the big bear that is the CPI data coming out from the US today at 1:30 p.m. UK time, just over 2 hours from now, approximately speaking. So I suppose this week the markets have been fairly tepid. Indices have kind of ground higher. Dollar has been fairly stagnated and flat between 103.50 and 103 levels on the DXY. So really not that much has happened following Friday's kind of exorbitant moves from the NFP data as well. So of course now we will be taking you through the CPI data, previewing I suppose the data ahead for the afternoon, and of course setting the tone for the afternoon, looking at some of the key pieces of information. So of course today in our Discord we did circulate kind of the forecasts from the Wall Street investment institutions, JP Morgan and co, Goldman Sachs, etc. And I suppose the big telltale sign was that the headline inflation today for a lot of institutions is around kind of 6.5 to 6.3%. So a lot of institutions in Wall Street now are expecting that 6.5 inflation rate. Even some are actually expecting the figure to be better than expected. So naturally enough, institutions, Wall Street, are trying to price in a much better than expected inflation story within the US. Now, of course, the big disappointment today would come whereby we get maybe 6.7, 6.8, probably 6.8, 6.9. I think if we see 6.8, 6.9 today, then I think you're going to see a very significant undoing of the price action, that kind of steady grind higher that we saw through the course of the week in the indices, but also undoing potentially some of the moves from last week's NFP as well. And I think it's just about being cautious of that. In a lot of the brokerages, a lot of the exchanges today, you'll probably get slippage. You'll probably get platforms freezing in terms of not being able to place the trades. So it is important to align yourself with like the likes of a tier one liquidity provider, where you are getting in as quickly as possible. You are getting the most recent quoted prices within the markets as well. And I think that's really, really important. Now, when we take a deep dive into the inflation, firstly, we can see kind of the progression and decline in the US inflation over the last, let's say, 5-6 months. We had that peak in July, August time. September, we were starting to see that kind of decline. October, we were at 8.2%. November, we were at 7.7%. And December, we were at 7.1%. Now, today, they're expecting January to be 6.5%. And if we see 6.5%, that means we'll have dropped from 8.2% in October to 6.5% in January, which is nearly a 2% reduction in the inflation rate. Now, that is obviously a very, very good thing. Why? Because it means then the increasing of interest rates that we've seen visibly over the last kind of 12 months or so is starting to work in the markets, and it puts us into a potential scenario where we actually see disinflation. And disinflation is a good thing because it means that as the inflation levels are coming down quite quickly, it means then that the central bank policy in terms of higher interest rates doesn't have to be as aggressive. And when it doesn't have to be as aggressive, their goal is then just to sit at the terminal rate and get the interest rates, which I think is about 4.75 in the US, lower obviously in Europe, to that terminal rate, wait for the interest rates to come back down underneath that level. And then as the interest rates continues to fall in the months after, the Fed and the BOE and the ECB can start dropping those rates back down gradually. Now, the ECB, if you're listening to Gundo's comments yesterday, he said that there is still a very, very long way to go in Europe. And of course, that's because the European Union is largely in a mess. You've got the issues with global debt in a lot of the major European countries now at the minute. And of course, if interest rates continues to rise and rise and rise and rise, that means that the refinancing of that global debt or European debt becomes a lot harder. And of course, who pays for it? Of course, the taxpayers. So it's important to factor that into consideration from a European mandate. But of course, that'll be interesting when we come to 2nd of February, 3rd of February, when we have the next set of interest rate meetings in Europe and obviously the UK as well. So obviously back to the Fed today, 6.5 is the expectation. Okay, so anything above 6.5 is effectively saying to us as traders that the data isn't quite as good as people expect. Now, if we see 6.8, 6.9, I do think you're probably going to see the indices unwind. I think if we see 6.3, 6.2, that's obviously a very, very good thing. Indices are going to fly. You're probably going to see weaker dollar. So absolutely then the intangible relationship today is, well, if the figures is good, we should be buying the indices. If the figures is bad, we either buy the dollar or we sell the indices. And that's really the important thing today. And now when we say the figures is good and bad, the inflation figures the CPI data, they are one of three pieces of information where we actually want the data to be coming in less than expected. Because, of course, when it comes in less than expected, it means that the costs of these goods and services within the economy are cheaper and are more affordable for households, for individuals, and, of course, for organizations who are maybe buying and selling materials as well. Okay, so that's obviously kind of where we are with the headline. If you look at the core, core is excluding food and energy, and we look at that and we've seen fairly significant declines. We've gone from kind of 6.6 to 6.3 to 6%, and of course today we are looking for core inflation to be down at 5.7. So of course that's looking at all of the other sectoral outputs within the economy as well, broadly speaking. So it'll be interesting to see whether that plays out or not. And I suppose the thing is now, can we start to see, as I said, disinflation? Can we start to see those inflation levels coming back down? And that'll be the big talking point, big discussion point into 1:30 p.m. But of course, immediately afterwards, as we head to the US session open at 2:30 p.m. from a cash price perspective. Okay, so that's effectively where we are. The economic calendar in the dashboard is very, very detailed and thorough. If you go into it, you can actually see it. You can actually look at previous months. You can see the delta. You can see the trends, how it's formed in previous months as well. And I think that's going to be particularly useful to see the rate of the increases, the rate of the decreases. And of course, when we come to the central banks, the Fed is meeting, I think, on the 1st of February. It's going to be very, very interesting to see how does today's mandate play out. Now, of course, if we see weaker than expected inflation today at 6.3, 6.4, 6.5%, although it's very, very high, it means then that the Fed will probably start to look into maybe reducing. So they've gone from 75s in September and October into 50s in December. The likelihood is now you'll probably start to see a couple of 25 basis point increases, get to that kind of 5.1, 5.25% terminal rate in the interest rates, see then hold it there for maybe 3-6 months, and then wait to see can those inflation levels continually dropping at a fairly rapid degree. And at that point, then the terminal rate will be above the interest rate, the inflation rate, which is obviously a good thing for the economy. Okay, and it's logical to think about it in that approach as well. Now, as we look from the inflation, let's take a quick deep dive at the data, right? So what have we seen on the DXY this week? Well, terribly not a great deal, right? We've been back and forth between 103 and 103.50. That is literally where the dollar has been all week. And a lot of the FX pairs has been fairly boring, to say the least. There hasn't been much going through. And I think that's because a lot of people aren't too... I suppose the word would be too focused on getting ahead of themselves, ahead of the CPI. Now, of course, if you look at the indices, the S&P, we have seen indices broadly rally over the last few days. Now, of course, that's quite interesting because we had areas of interest down here on Monday. We had the initial profit taking from NFP on Monday evening. We had that kind of pullback into Tuesday. Into Wednesday, into today, we actually have seen the indices rally. Now, they've only rallied about 80 points, so not a massive move in the indices, the likes of the S&Ps. However, it's still factoring in the price action today is still tilted to the upside. Indices are still in control as we speak. Now, whether that plays out or not, as again, is going to be determined on the price action of 130, because of course, if that CPI figure is 6.8, 6.9%, you're going to see the indices come back down. You're probably going to see 38.20 being potentially met on the S&Ps as markets try and sell off, and that could potentially be 3-4% decline on some of these indices, and that's across the board, right? You look at the Nasdaq. Very, very similar narrative. We've broken through that short-term high we talked about earlier in the week at 11.3. We're now sitting up here at 11.4. And of course, we do have this unmitigated area of interest on the Nasdaq up around 11.8. So I think that's going to be an interesting focal point for the day. Of course, Dow Jones has continued to kind of soar higher through the last couple of days. Of course, this is where we were on Tuesday at 33,400. We're now sitting up here nearly 600 points higher, 2% higher. At 34,000. I think that's going to be a key consideration here is this week is to see how does the indices react. Do we see that influx and progression in the upside across the board? S&Ps, Nasdaq, Dow Jones. Do we see gold prices elevate to the upside as well? And we'll be looking at gold prices shortly as well. So I think that's really quite important. I think a lot of guys, some are obviously positioning into the open or into the CPI data, which I think is quite risky per se, from a kind of a medium term perspective. Obviously the short term traders, that's obviously a different type of strategy, different type of plan. That's fine, but it is obviously quite important today, the information coming out at 1:30. Now, if we look at gold, Structurally speaking, gold has quite a little bit to run on the daily. If you look at the daily structure, a lot of the daily order blocks, liquidity areas is up here, kind of 1950, 1975. We have kind of broken through today initially this 1875, 1880 local area here on the price action. So gold is trying to rally even higher. If we see those CPI figures coming out lower than expected today and better for the markets, you're probably going to see gold fly. You're probably going to see gold back above 1900, 1910, 1920, with the idea of really coming back up into some of these higher benchmarks, 1950. 1975 probably over the next week or so. So just looking at that broadly speaking as well. Now, if we look at oil is something that I've been kind of tracking lately. Obviously, one was the daily order block here at 70. That was kind of the year-end low. Then we obviously flagged back up into the 80s. 4-hour structure has obviously seen oil pick up again over the last few days. Given the recent rejection at 82, we did come back to 73, and we are now trending higher back up into 80, 81 again. So I would not be surprised to see oil, WTI, crude, really sitting up here around 80, 81 today. I think that's a logical scenario as well. But something to be kind of relevant against, particularly with the CPI figures, and of course factoring that into consideration. If we look at European very, very quickly, the DAX has just continued to soar, FTSE has continued to soar, Euro stocks is continued to soar, European indices, that rampage we talked about earlier in the week is still playing out. European stocks are just continued to move higher. Really, really significant moves. But of course, if that CPI figure comes in worse than expected today in the US, you're probably going to see European indices, UK indices, broadly global indices will probably see a little bit of sympathy. They'll see a bit of decline in them as well if the figure is higher than people are expecting as well. So just be kind of wary of that. And of course, FTSE making its way up again. That steady climb in the FTSE is continuing to play out. We've gone from 77.50, we've broken through 7,700, and now looks like 78.25. 7,800, 7,825 really becomes the next upside target for the FTSE there. Now, if we add in, just on a side note, if we add in a couple of FX charts very, very quickly, we're going to look at euro and cable just into obviously today's CPI. First things first, euro and cable really, again, with the FX story has been fairly flat. We saw that run up last week in the euro. We saw that run up last week in the cable off the back of that NFP. But really since then, the FX pairs haven't done a great deal, right? We haven't seen that progression like we've seen in the indices, which means that there is potential opportunities there coming through in the FX markets. But of course, that is really going to be, I think, data dependent today at 1:30. Now, you're going to see slippage. You're going to see volatility in the data. You're going to see very, very choppy movements, potentially at 1:03, 1:30 p.m., particularly if the data is either very, very good or very, very bad. I think the worst case scenario is that we see kind of a 6.6, and then maybe we don't see that much of a reaction, but we're probably going to see a reaction either way. And I think it's important to be aware of the volatility that's potentially coming down the line in just a couple of hours. Okay, so that's pretty much it for the moment, folks. We'll be back tomorrow just to kind of recap on the CPI data today, obviously the effect in the markets, the data, obviously reconciling that with the price action, and of course setting out the tone for the rest of the week, broadly speaking. So obviously today, the big driver is the CPI. We do have ADP numbers as well. I would be less focused on the job claims. Really today is going to be all about inflation. Of course, tomorrow we do have GBP growth, production output coming out in the morning time. And we do have some European figures as well. But I think really tomorrow is again going to be back to the US, of course, because we have Michigan Consumer Sentiment Index as well coming out. But as I said, the big figure today, this week, is going to be the CPI figure this afternoon. So please trade safe. Please utilize risk management. Everyone, don't be over leveraging your accounts, whether it's with us, whether it's your own personal accounts, whether it's with other organizations. Please use risk management sensibly. Otherwise, you're potentially putting yourself into a very, very difficult and precarious position today. All right. Trade safe. Have a great afternoon, everyone.